Hello everyone, it's Wednesday, February 18, and today we will analyze the charts for the euro and the British pound to identify potential market shifts. In early trade yesterday, demand for the euro was subdued, weighing down by weaker than expected data on economic sentiment from both the euro area and Germany. Later in the day, traders received positive statistics from the United States. The New York Fed's Empire State Manufacturing Index for February exceeded analysts' expectations, which fueled dollar buying activity. However, remarks from Fed officials reversed the trend, putting pressure on the greenback and allowing risky assets to gain traction. Notably, Austin Goldsby indicated that he anticipates at least 2 interest rate cuts this year, contingent upon continued inflation cooling. Meanwhile, the pound sterling faced significant pressure due to disappointing data from the UK labour market during early trade on Tuesday. The currency even fell to a new one-month low during the US session, but later rebounded, buoyed by comments from Fed policymakers. Turning to today's macroeconomic calendar, it features a series of important releases on UK inflation. This data is particularly significant for traders in light of a slowdown in the labour market, where unemployment rate has spiked to 5.2%. British consumer price inflation is expected to experience a notable slowdown, with forecasts suggesting a monthly decrease of 0.5% for January 2026 and a year-on-year decline of 3%. If the figures come in above expectations, the Bank of England could face challenges and proceed with further rate cuts. Conversely, if data confirms easing inflation, the pound sterling may weaken on expectations that the regulator will have reason to continue its active rate cutting cycle. Core consumer prices, retail prices, and producer prices will also be in focus for market participants. In addition, France is scheduled to release its inflation data. Later in the day, attention will shift to a variety of US statistics, including durable goods orders, building permits, and housing starts. Traders will closely monitor minutes from the Fed's latest monetary policy meeting, as well as speeches from Fed officials, including Michelle Bowman. To inform their trading strategies, market participants will be looking for clues about the central bank's next policy move. Now let's move on to technical analysis. The 1-hour EUR USD chart shows that the situation has barely changed since yesterday. A decline followed by a false breakout at 1832 would generate a buy signal, pushing the euro up to 1863. At that level, sellers are likely to step in, making a false breakout there a selling opportunity with a target back to 1832. If the price breaks below 1832, the euro is expected to slide to 1804 and could extend weakness to 1.1769. At this mark, I would recommend going long on a rebound, targeting a 25-30 pip move. Long entries at 1804 should be considered after confirmed false breakout. Alternatively, if the price rises above 1863, buyers could push the pair up to 1889, where a false breakout would again provide a selling opportunity. Going short on the rebound would make sense at 1925, aiming for an intraday correction of 25-30 pips. Regarding the British pound, the setup is similar. If UK inflation prints below expectations, sterling could break below 35.49 and extend losses to 1.3523, with the potential to drop to 34.96. At this level, I would look to go long on a rebound, targeting roughly 25-30 pips. Long positions at 35.23 and 35.49 should be considered only after a false breakout. Conversely, strong than expected inflation, which would reduce the likelihood of further easing by the Bank of England, could push the pound higher. A break above 35.77 would open the way to 36.03, where a false breakout would present a selling opportunity. Going short on the rebound would be relevant at 1.3632, targeting a 20-25 pip move. Best of luck to everyone.